we stand for the national anthem?
Stand and sing of Zambia, proud and free, land of wealth and joy in unity, victors in the struggle for the right. We won freedom's fight, oh, one, strong and free. Africa is our own motherland, fashioned with and blessed by those who blend. Let us, all our people, join as one, brothers under the sun, oh, one, strong and free. One land and one nation is our cry. Dignity and peace in Zambia's sky, like a noble eagle in its flight. Zambia, praise to thee, oh, one, strong and free. Praise be to God, praise be, bless our great Zambia, Zambia, Zambia. Remain we stand under the flag of our land. Zambia, praise to thee, oh, one, strong and free.
We may remain standing for a prayer by Ms. Chilombo Kapembwa, our operational risk management specialist.
Shall we pray? Heavenly Father, we come before your throne, thankful for this day that you have given unto us. Lord, we thank you for the gift of life and the other blessings bestowed upon us. This morning, we want to pray, committing the MPC announcement into your hands. We pray for your guidance and your wisdom in this meeting. In the name of Jesus Christ, we pray. Amen.
Thank you very much, Chilombo. We may be seated. The governor, deputy governors, members of the Monetary Policy Committee, directors here present, members of the press, ladies and gentlemen, I welcome you to our fourth Monetary Policy Media Briefing for the year. As you may already be aware, the Monetary Policy Committee held its meeting on Monday and Tuesday, and this morning the governor will be announcing the decision of the committee. To our online audience, we acknowledge your presence and we say thank you for joining us. Allow me to introduce to you the dignitaries in front of you. We have the governor, who is flanked by the two deputies. On his right, we have Deputy Governor Dr. Francis Chipimo, and on his left, we have Deputy Governor in charge of administration, Mrs. Reka Chifue Muhango. Next to Mrs. Muhango, we have Director in charge of research, Dr. Jonathan Chipili. Next to Dr. Chipimo, we have Director in charge of financial stability, Mr. Goodson Kataya. I will not waste much of your time, but call upon the governor to address the press. Governor, sir.
Let me join Bessie in welcoming you to this Monetary Policy Committee briefing. And since this is the last time this year we will be meeting this way, let me wish everyone safe and peaceful holidays. Let me recognize my colleagues here, the Deputy Governors, Dr. Chipimo and Mrs. Reka Muhango, the Directors, the Research, Dr. Chipili, and Director Financial Stability, Mr. Kataya, and the members of the MPC who are seated here in front. and other colleagues from Bank of Zambia, members of the media, welcome once again. Hey, the presentation this morning will be in 6 parts. Start out with the decision of the Monetary Policy Committee, to be followed by inflation outturn and outlook, which is the main focus of the report. Then we look at the developments in the foreign exchange market, so far as they affect monetary policy and the inflation, credit developments in the economy, that too as they affect inflation and the financial stability. Then we look at how economic activity has shaped since our last meeting in August. And finally, we'll provide a conclusion, which will really be a sum up of the earlier presentations. The decision of the monetary policy at its meeting, November 11 to 12, 2024, the Monetary Policy Committee meeting decided to increase the monetary policy rate by 50 basis points to 14.0%. You recall that in August, the committee paused the process of adjusting the policy rate. But why did we do this time? Well, our observation is that there has been an increase in both actual and projected inflation, which shows that inflation now continues to be above the target band of 6 to 8%. The decision, therefore, to raise the policy rate is aimed at steering inflation back towards the target band and anchoring inflation expectations. By anchoring expectations, we have seen from the different work that we do, members of the public, business community tend to be expecting that inflation will continue to rise. But a continued rise in inflation is obviously not desirable, and that's why the bank was given the primary mandate of price stability. In arriving at the decision, the committee also took into account a number of factors. One, complementary liquidity management measures. What you appreciate is that the policy rate is mainly targeted at arresting demand pressures. Now, as you see in the presentation, aggregate demand is on the decline because of the effect of the drought, where now GDP is projected to end the year at 1.2%. So when you look in the aggregate, demand has reduced, and hence also our moderating the increase in the policy rate. Two, we took account of what is happening in the foreign exchange market. We did embark on a number of reforms in the foreign exchange market to address some of the volatility that we had been seeing in the exchange rate. So these reforms are still continuing, so they must be viewed as part and parcel of the measures that the bank is taking to get hold of the pressure on prices. Three, we also took into account the fragility of the economy, as I indicated, in the wake of the severe impact of the recent drought. You will no doubt be part of the people who can bear testimony to this, that the drought has affected many aspects of our lives, not least the electricity generation. In some, it's now improving, but we had situations where electricity would only be available for 3 hours, even less. And finally, we had also to take account of what happens to the financial system. Is it going to be stable, or is it going to be destabilized with the changes that we are proposing, or we have made rather? So this, in a summary, is what prompted us to raise the policy rate by 50 basis points. Now let's go to the details of where this is coming from. When you look at inflation outturn, what we observe is that annual overall inflation continued to rise in the third quarter of 2024, averaging 15.5% from 14.6% in the second quarter of 2024. Let me just show you the table. Yes. This is the usual table we show you. We add and drop some columns. So this time we are focusing on the third quarter of the year. So what you see is in two parts, as always. The first part looks at the average of inflation on a quarterly basis. Then the bottom part, we show the end period of inflation. So if you focus your attention on the second row, which refers to overall inflation, you note that inflation has been rising. If you even cast your eyes back to 2023 third quarter, it was 11% on average. It rose to 12.9, 13.5, and the more immediate past, in the second quarter, it was at 14.6%. So what we are saying is that this trend has continued in the third quarter. Now, the components also reflect that, obviously. What we see is food inflation has been rising to 17.6% in the third quarter of this year. And the non-food slowing down, but still rising to 12.5% in the third quarter. When we look at end periods, that is at the end, the month for the quarter, which is September in this case, you see a similar phenomenon where overall inflation has risen to 15.6% from 15.2%. And you look at the components again, food has risen to 17.9%, and non-food has gone down slightly, partly because of the measures that have been taken to this point. So the key drivers of inflation that we are observing are low supply of maize grain. Clearly, we didn't have a good harvest, so the supply of maize grain has been lower than expected. Fish and vegetables, and we have seen on the demand side an increase in demand for solid fuels, as you would expect with the erratic electricity supply from the national utility. People have had to resort to using generators, which means that you have to buy a lot of fuel, and that has pushed up the demand for that. The kwacha has also been depreciating, though moderately during this period, as I'll demonstrate later on. So if we look now to charts 1 and 2 to just show pictorially what that means. You can very well see, if you look on the left side, hand side, is the contribution to overall inflation of the food subgroups. So what you observe, if you look at the coloring, where the brown part at the bottom there, that is representing bread and cereals. Then that blue part which has grown, that is representing the fish that I highlighted earlier on. Then you look at the red, that will be representing the oils that I also referred to. You can see the size of that bar is slightly bigger than in the previous period. Then you have the greenish part, those are vegetables. Again, there we see that vegetables are not as in high supply as we normally see. Then you have that blue up there, sugar jams. But there's a new category which has emerged as one of the drivers, the yellowish one at the top. You will note that in the previous period, that was not featuring as much. So that is fruits and other manufactured products. So that is showing you some of the pressure points in our inflation basket. Then on the right-hand side, we are doing the same, but this time looking at non-food subgroups. There you see that the blue line there, the blue shading, that is representing housing, water, electricity, and gas. Then the following one, I think that's transportation. The red is miscellaneous goods and services, and the then the greenish one, that's alcohol, the creation, and the accommodation. So you see that whereas the bars on the inflation, on the food side are bigger, on the non-food side they are smaller, which reflects the slowdown that I referred to earlier on. If you look, this nice looking is not innocent in the sense that underlying it is the pressures that we are getting from the high cost of living that everyone is talking about. Now, when we look at the outlook, that is, how do we see things unfolding in the period ahead? What we see is that is a continuation of inflation remaining above the target range. That is one of the reasons why we are concerned to do something about it. So look at chart 3. The solid line represents what has happened. The dotted lines show what it would be like based on our modeling that we do. So what you see, the red one is representing what we are forecasting today in November. The blue one, on the other hand, is what we had forecast in the last period, which was in August. Clearly, what you see is that although the inflation profile shows that it will come down towards the target band towards the end of the forecast horizon, in between it is up and is even above the previous projection. So this is the concern we are trying to address by raising the policy rate. In the figure terms, we look at table 2, where we are showing that in November now, 2024, inflation is projected to average around 15%, start to come down as depicted in the chart to 13.9% in 2025 and 9% in 2026. It's not the full year because we do projections over 8 quarters. So the 8 quarters, I don't think it will go to the end of the full year in 2026. Whereas in the August projection, this is the profile you are seeing was lower, although higher at the beginning, but it is lower this time around. So this as I said, is what is concerning us. While inflation is projected to remain around the annual average, I think I've already stated that, but perhaps is to stress the factors that are driving that profile that we have looked at. One has to do with the depreciation of the exchange rate and the increase in the electricity tariffs, which we all know what is the cause for that. So I think I have already stated that, so let me make progress. Turning now to the foreign exchange market, what we are saying is that in the third quarter of 2024, the depreciation of the kwacha against the US dollar moderated further to 1.7% from 3.8% in the second quarter. I think we are even hearing people saying, what are you doing? Why are this? You see some of the reasons why this has happened. This, if you look to the chart on the right figure, we have that a line there which divides like in the above and below. What you see, if you look, that's the monthly percentage change. You can see that it has been coming smaller, which is what we are looking for in terms of stability in the foreign exchange market. But when you look at the kwacha US dollar in terms of the quantums, that there is that movement, it obviously shows that that relationship is also affected. So that's what the black line is showing. It's showing that the kwacha is depreciating, but at a slower rate. Why this smaller movement? The smaller movement has been occasioned by the reduction in demand pipeline, or what we call the backlog, due to continued improved supply of foreign exchange and relatively weaker US dollar induced by heightened expectations of the interest rate cut by the US Federal Reserve. In addition, the reforms that I referred to at the very outset in the foreign exchange market are contributing to this outturn. But let's look at the backlog. This is a depiction of the pipeline. When we are saying that there are people who are demanding forex in the market, this is how it shows. So if you look at July 3rd, 9th this year, you see this spike. There was quite a lot of demand for foreign exchange. It reduced, stayed low for some time. It bubbled again, came down. Now, when we look at the last part, which is where we are now, you can see that it had spiked, but lower than in the previous. But that spiking also translates into the movement in the exchange rate that we are referring to. And as it was coming down towards the end, it shows that slacking that we're talking about. So let me go back to where I started this conversation. We said that there was an improved supply in the foreign exchange market during the period we are referring to. The source of that was mainly the mining sector, which came in at $232.1 million. That was followed by foreign financial institutions, which brought in $61.6 million, and the construction sector also weighed in with the $49.0 million. So that's what contributed to the relative stability that we are talking about. But the receipts, the mining receipts that were remitted to the bank, to the Bank of Zambia directly, were slightly lower. We got 233.8 million compared to 252.5 million in the previous period. This was on account of lower copper export earnings as realized prices and the volumes declined. So if I may just focus for a few seconds on the chart on the right, which is chart 5, this is what the mining sector contributed by way of taxes to the Bank of Zambia. So what we are saying is that the amount contributed was lower than in the previous period, and I already explained what that. So the blue there is representing mineral royalties, and the other is the non-mineral royalty taxes that the mines pay. Now, due to the increase in the foreign exchange supply, market support by the bank had to obviously be reduced. So during the period, we did supply, by way of market support, $230.8 million from the previous $275 million. Then when we look at the activity in the interbank foreign exchange, this is the trading banks to banks, you will note that sometime in the past, actually activity had defrozen. But this time around, it was quite robust. We see that the supply or the turnover rose to $324.4 million US from, look what was the case in the previous quarter, $77.7 million. This, since 2021, marks the highest. So you can see that we have had a very long dry spell of activity in this interbank market. This is healthy, and we hope that going forward, this will be the way things proceed. The outstanding demand for foreign exchange on July 17 was $126 million. This was a marked increase from the $17.9 million that we saw on July 3rd. So that's the pressure point that I was referring to. However, in the fourth quarter, demand has remained. This is the current period we are reporting as at the 4th November. We see that demand has risen, and I'm sure you have seen some pressure points in the exchange rate in the market. So the kwacha rising from that has depreciated by 3.1% against the dollar as up to yesterday. Continuing with the foreign exchange market, you always want to know what is happening to gross international reserves and how we are faring in terms of import cover. What we want to demonstrate is that actually we have reserves going up. We have seen some media reports suggesting otherwise, but this is what we know from our end, that the reserves have actually gone up to $4.15 billion, representing 4.6 months of import cover from the previous $3.91 billion and equivalent to 4.3 months of import cover. That's the chart on the right-hand side. What was the source of that? Is mainly disbursements from the World Bank and our net purchases of mining taxes. We say net because we provided some of that to the market in the process. In the third quarter, we also get a question here, what happened to gold reserves? What we are saying is that we did purchase gold to the tune in value terms of 7.3 million, bringing the total holdings of gold to $217.2 million since the program started in 2020. Let's move on to credit developments. What we see is that overall domestic credit growth in nominal terms, I think it's important to underscore nominal terms, because with rising inflation, obviously you should see that in real terms, that is kind of moderated. So what we are seeing is that even in nominal terms, this stayed steady. When you say it stayed steady, then when you look in the real terms, you see that actually it is a decline. The private sector credit, if we unbundle that, we see that slowed down in September to, that's the growth which is slowed down, not the credit per se, to 29.7% year on year, from 35.8% in the previous period. Lending to government through government securities, on the other hand, increased as liquidity conditions broadly improved. Now, just to give you a sense of what is happening by way of non-resident holders, because this question also comes up from time to time, we are saying that the total outstanding stock of government securities is at 225.03 billion as at end September. During the year, there has been some pay down by government of some of these type of credit that has been going on, because when there are shortfalls in the auctions, the government moves in to meet that shortfall, and in so doing, that means they are reducing their indebtedness to the public and the other players. Out of this amount, the non-resident holdings were 53.9 billion, representing 23.9% of the total holdings. Let's turn to the last bit, which is economic activity. What we note, and which has been said by many others, is that economic activity weakened further in the third quarter as business conditions for the private sector continue to deteriorate. This is attributed to the deeper than anticipated impact of the drought on electricity generation, which had spillovers to other parts of the economy. The drought has resulted, sadly, in the real GDP growth rate being downgraded significantly to 1.2% from 2.3% that had been projected earlier. This has very important implications in terms of anchoring the 2025 budget in terms of resource envelope. So this is something as a committee we also took account of to see what happens. But inflation is also not a good thing. It's actually an enemy of everybody. So that's why we have to do trade-offs in the way we manage our affairs. But going beyond this year, the prospects look much brighter. We are hoping and praying that the rain season this time around will be much, much more favorable. And if that turns to be the case, then we should see some recovery in agriculture. We already see some big projects going on in the mining sector, whose contribution will only begin to show for some of them next year and the period ahead. The ICT sector, we see this continuing to expand. I can see everybody here is either has a phone they are looking at, or a laptop, or an iPad or something like that. These are the things that we are talking about, that they are contributing to this. So the financial and insurance sector is also growing, and we expect that to continue to be the case in the period ahead. Wholesale and retail trade sectors are growing. But here I think we just want to sound the caution that you see, when these are growing, we should be concerned to some extent that if the composition of the goods that we are getting are imported, then we really need to look at ourselves. What are we doing to substitute some of those by local goods that we produce ourselves? So let me conclude then, therefore, to go back to where I started. We are saying that the MPC decided to increase the monetary policy rate by 50 basis points to 14%. The increase has been necessitated by both actual and projected inflation continuing to remain above our target band. I should stress here that we are not saying that right now we have to get in that target band, but in the medium term, the idea is for inflation to be within that target band. But if we don't take action now, it will continue drifting further away from the target band. So that then undermines all your good efforts to make money, because the purchasing power of that money will be reduced. So we also took other factors into account when looking at this, that the economy is relatively fragile, but there has been quite a lot of resources pushed in the economy. Yes, they are well intended, but unfortunately, when you have limited supply of goods, that money tends to push prices up. So some demand management has to happen, otherwise you get inflation continuing to rise. We are also looking at invoking other measures to manage that liquidity, which has an impact on the exchange rate, which as you have seen, has a big impact on inflation. So we are saying that going forward, we are going to remain vigilant and take any measures that we deem necessary to address inflation, but will not do this in isolation. We work with other players. We are looking also at some other facilities that we need to roll out to moderate some of the impact that we see our fellow citizens are enduring. Thank you for your attention. God bless.
Thank you very much, Governor, for that presentation. We will go for our question and answer session. And as always, we'll take 3 questions at a time. Please ask 1 question so that we give chance to as many people as possible. If you have more than 1 question, we should be able to take your second and third question after we have given everybody an opportunity. So do raise your hand. A microphone will come through to you. As always, state your name and the institution that you represent, then you can proceed to ask your question. For our online audience, please continue to post your questions on our online platforms, Twitter, and the Facebook page. So who will give us the first question?
My name is Munyumba Mutwale. I'm from the Business Telegraph. The first question I'm going to ask, hopefully I can get the others through later, but the first I wanted to ask was, recently in the world we've seen a big event, obviously the US elections, which markets are starting to respond to globally. The President Trump's election and also the Republican clean sweep. One thing we've seen is that interest rates in America have started going up on expectations of rising deficits. I noticed in the presentation we talked about interest, the expectations of Fed rate cuts, but we're starting to see Treasury yields going up on the expectations that with the Republicans having full control, they're going to have they're going to have heavy tax cuts, and their tariff agenda also might cause a little bit of inflation in the American economy. And then also we started to see the dollar getting stronger again. So even in our presentation here, we're seeing, we're talking about the fact that the dollar started to get weak. That affected the FX market. Have we now adjusted our calculus for the new American political landscape that comes with a stronger dollar, potentially higher for longer interest rates, and a deglobalized world, a more aggressively deglobalized world? Or is that already factored into the outlook that we've given? I know that it was a recent event.
Thank you, Munyumba. You can get the next question.
My name is Rachel Mumba. I'm from Diamond TV. Mine is just to seek clarification on the alleged ban of money bouquets. Thank you.
My name is Kalunga Mope from Millennium Radio. My question is on recently, I think there was a revelation, and I think it has not yet been clarified. About 14 billion kwacha were used by the commercial banks to issue government bonds. And recently, we heard to say apparently money for CDF is also being used to issue government bonds or other government securities. I don't know the clarity in as far as that is concerned, because we had to say the money was used to actually stabilize the kwacha at some point. So maybe just some clarity.
Governor, you may take those 3 questions.
Thank you very much for those questions. I have colleagues here who can help in some of this. For money bouquets, either DGO can weigh in, or the Director Banking Currency can deal with that. Mutwale see forward-looking. Well, as you rightly pointed out, this is just unfolding. So the extent to which we could factor all these aspects is very limited. But we do take in the projections some of the likely impact in terms of risks, because our projections take what risks we see in the horizon. But this is just unfolding. But that interest rates start rising in the US is a concern, obviously, in that the cutting trend that had been going on is now being reversed. We will remain expectant to see what will happen, but they are guided by their own assessment of the developments in their domestic market. But definitely when the dollar strengthens, we feel the pinch here, because it means that investors who were trying to look to us as a possible destination now reevaluate their standing, because they feel the other is a bigger economy, and therefore they are much safer there, because the perceived risk is much higher in our setting than it is in that setting. So it's something to definitely be on the lookout for. We'll see what happens, because the actual taking of office is next year. But like you have stated, there are immediate reactions, but we'll see whether those get sustained or not. So I think that's what I can say, that we will continually to look at that, but a strengthening dollar is not good for us, in the sense that it draws away capital flows from us, and that also contributes to further inflation. But I must use this opportunity also to indicate that as a country, along with other countries in the region, we are working on finding payment methods that do not include the dollar, where we can use our local currency, the kwacha, to make purchases of various items. In fact, this system is already in place for SADC region. We call the RTGS, the real-time gross settlement system. A number of banks are signed up to that. But probably this is an area where you can help us to make this known to many players, because for some of these imports that we are doing, they could be settled in local currencies. We are also as a continent under the AFCTA working towards a continental wide payment systems. One of the promising ones which we signed onto as Zambia in 2022 is the Pan-African Payment and Settlement System, PAPS, which is being provided by the Afrexim Bank. Now, we are working closely under the national switch to link up this so that we can be using our local currencies in our transactions with fellow African countries. It doesn't make sense, as somebody pointed out. If you say I want to go to Botswana, I have to change into dollars, then you go there, use those dollars, change into pula. We could as well have used that directly. I noted that, in fact, the new president was even talking about the movement of people. Why is it easier for people from far off places to enter our countries than us going move? So movement of people, movement of goods, money will follow into that. So these are some of the things we are working on jointly, we are bilaterally, to try and moderate the use of the dollar. You have seen also here, we had been talking about promoting the use of the kwacha for domestic transactions. This becomes even more relevant in the period ahead, which we are talking about, that we have to do this. We'll be coming back to the members of the public because we did some consultations, and we're coming up with some ideas of how together we can move to promote the use of the kwacha for our local transactions. Like I said at the end of my presentation, if the growth in wholesale and retail trade is being driven by consumption of imported goods, then we are shooting ourselves in the foot. We need to produce more of the local commodities. Maybe let me turn to DGA to weigh in on the use of money in bouquets, money of presents.
Thank you very much, Governor. I think on this, what we can say is that we strongly discourage this practice. For us to release the money which we do, it's procured at a very high cost. And we do have policies in place relating to how we should utilize money. In fact, under the Bank of Zambia Act, the willful mutilation or degradation of the currency is actually punishable by law. I think it's something like maybe 1 million penalty units, and if you're convicted, it would be up to 10 years in prison. So, the law already is set up so that we don't expect people to utilize money in a way in which you're actively degrading that money. It really is not helpful, even just for the proper use of money. If you think this money goes into ATM machines and all the other ways in which we want to use cash. So we really strongly discourage people from treating money in a way which degrades it and is not being used in the way it should be. Thank you.
Kalumba, your question is a bit confusing. I didn't quite follow. You are saying that there was 14 billion, and you think part of that 14 billion was coming from CDF, which was used to buy government securities. I don't know. We are not aware of that. We don't know where you got that information from. We would be interested to know the source of that information. I think back in May, when we are trying to move the idle government balances in commercial banks, was trying to get government to have better management of its cash resources, and at the same time, indeed, curb use of or borrowing its own money. We were not saying that they had borrowed their own money, but there are possibilities that the government, in some cases, could be actually borrowing its money if it stays longer in commercial banks, because banks are in business of making money. So if money is sitting idle there for some time, they will use it. That's the whole model of banking. You don't expect everybody to come and draw money at the same time. So that float can be used to go into foreign exchange market. This is why we were interested in mopping up that money. But we are not aware of that. The stabilization of the currency, yes, to the extent that we are removing that money from being used for this purpose, where they would go overnight and buy foreign exchange, definitely it destabilizes the currency. Yet, this is the money which is supposed to go to specific projects and programs that the government is running. But when it sits idle there, it gives others ideas. Just to give you an idea, banks make money overnight. You see, for you go to sleep. Your money doesn't sleep. It's being used. And more so with these time differences across countries. Now, payment systems are very active. So your money can go, it's like you going out on a night to the nightclub. The money is used in that, and in the morning, you get your balance, but it has earned some interest which can be destabilizing. This is why, even in the foreign exchange market, we came up with the idea that when you are interacting with an outside party, we'll look at you who is doing that. Are you doing it in conformity with our regulations? Because if you are not, then you are introducing instability into our markets. Because you find that sometimes you close the market, you wake up the following day, the exchange rate has moved. Who was doing what? So, but that's too late because it has already happened. But having said that, we are obviously pushing for more time. I think you may have already noticed that RTGS now is open at I think 1930 hours each Monday to Friday. We used to close 4 hours earlier. That has now been extended. The idea is that we want to go to a 24/7 economy. Because let's face it, colleagues, is that with the amount of unemployment that we have in the country, if we can afford to be sleeping more than 12 hours, then we are not serious about generating employment. Yes, we do have this challenge with electricity at the moment, but that's not a permanent feature. Measures are being taken to change that around. And even at individual level, people are equipping yourselves with alternative sources of power. So going forward, we are really pushing this idea that let's work around the clock. Many of us here who went to school abroad, you probably made your living or to pay for some of your school needs by working at night into some place. Why? It's because they are open. But in our case here, 17 hours, 18 hours latest, or some few isolated official ones, 20 hours closed. Now, RTGS was one of the reasons which was being used to say, why should we pay this? Now we are making it available so that you can access your money and be able to transact. That way, there will be more economic activity and we'll get more people employed. So that's, to use your question, I had to ride on it to give this additional information. Thank you.
Thank you very much, Governor. So maybe before we take another round here, we can look at the questions that have come through from our online audience. So I'll read out 3. The first one is from Amit Gupta, and the question is, what factors can reduce the stress on the kwacha against the dollar? The second one is coming from Longo Oliver Simumba, and the question is, the IMF's report on Zambia's extended credit program emphasizes that market-driven incentives are necessary for effective de-dollarization. Do you agree with this? And if so, what are the market incentives that need to be introduced? The next one is coming from Kelvin Chisanga. And the question is, why shouldn't we work to reduce on the statutory reserve ratio, since it seems to be a sharper tool currently, unlike going by triggering of the moderate rise in the policy rate? I think we need a cheaper source of cost on the side of capital stock in order to warrant growth by running predictable productivity. Your comment, Governor.
The first one by Amit Gupta, factors to reduce pressure on the kwacha. I think we have been talking about this time and again. There are 2 main issues here. I think I went at length to explain about these payment systems where we need to use our own currency. That's one. 2 is if you have a test for imports, then export more. That's the bottom line. We have to increase exports earnings so that we earn the foreign exchange we can use to buy those imports. That's a more sustainable way. But the other way, the reverse of that, is for us to produce goods which serve as substitutes for the imported commodities. Now, oftentimes, when you go into a shop, you find people have an eye for imported items. Why? One of the reasons say, no, these local ones, they are of low quality and all that. But, ladies and gentlemen, we won't improve if we are not given business. So, yes, you may start out with some product which may not be meeting your specific needs, but with time, there is learning. At the risk of perhaps offending somebody, but at the same time uplifting them, is Trade Kings. If you look at what has happened to Trade Kings products, when they started, they were not products, people were just discarding them. But now, they are much sought after goods, products in the cleaning industry, home, and so on. Why? It's because 1, they persisted. 2, you were beginning to buy. Now that you buy more, they are encouraged also to invest in research and development and improve the quality of those products. It can't just happen from nowhere that suddenly you have a very good product. No. Give you an example, those of you who are old enough. Japanese goods were looked down upon when we were going, these radios, ITT, the thing. The moment he says Japanese, he said, no. But they went and perfected the art. Now they are much sought after. Same, more recently, if you look at what is happening to Korean vehicles, the Kia, Hyundai, what was happening? They were saying, no, these are just copying Honda. It's supposed to be Honda. But nowadays, can you say that? Even the US, Europe, they are in high demand. Why? Because there was some outlet for them to do. So what we are saying is that we must also be proud of what we produce. What you produce, you must be proud that you are putting your best foot forward. That way, then we'll be creating jobs, creating the income that we need, rather than us complaining that they're externalizing money. Yes, they came here to make money. That's the bottom line. You can't come all the way from somewhere else and want to subsidize us. No, it doesn't work that way. That's not how life works. You are looking for a business opportunity, you see it, you make money, and you go. Why are we not seeing those opportunities ourselves? Others are seeing, but us, we see problems. Why is that? I think we must question ourselves some of this. Yes, you might say capital is an issue, but is that all the problem? I doubt it. We interrogate this. We have had facilities government has put as empowerment. What happens? We don't want to pay back once we get those things. So how do we grow, if you don't build on what we have? So really this issue is also an individual fight for us as individuals. What do we stand for? Much as it is for business to do that. But if you are shunning demand of these things, look now, I'm facing here. Before, we didn't have many of these cameras or many of these stations which you represent. There was just certain BC. But now look what is happening. There are more radio stations, there are more TV stations, which means that the industry is growing and more employment is there. So similarly, there is no magic bullet in the foreign exchange market. It's us to produce more of what we can export and produce more of what we consume so that we take as substitutes. That's what I can say on this. So it's not a monetary policy issue alone. It's much bigger than that. Long, I think Dijo, you can take that one.
Thank you, Governor. I think I'll maybe address the issue of, I think Oliver Simumba on the issue of de-dollarization. I think the question was relating to the recent statement by the IMF on the successful reaching of a staff level agreement. So a couple of things here. The first is just to commend the government for having reached that agreement. I think it shows that progress is being made and that the government is meeting and reaching its commitments. The second point is that in the context of what the IMF means, I think it's not for me to talk or explain for the IMF. I'm sure they are well capable of explaining what exactly they mean. But there are a couple of points which I'd like to point out. The first, of course, is that when this issue first broke, I think at some point there was a paper, I think, which was circulated, done by the IMF, talking about de-dollarization in general and experiences across the world. And I think one of the important points which had come out of that paper, of course, was that, at the end of the day, in places where you have seen de-dollarization, very often these situations arise, or when you have extreme dollarization, if you like, unless it's part of an agreement by the state that you decide to adopt the dollar. But where it happens in our market economies, very often it's a lack of confidence driven by either you have very, very excessive debt or your fiscal deficits are very high and you're not spending appropriately. And so therefore there was the quite sensible suggestion that you need to make sure that whatever you're doing, you do take those things into account. And I think our point is simply, and of course then this increases confidence, and as the world works, confidence begets confidence. But we had a very interesting conversation about this at the IMF with Governor, and one point was made that in Latin America, as an example, it took decades for this process to take place. So the issue we are saying is simply this, that as Governor has been indicating, we do need to promote the use of our currency because this has important benefits in the way in which the economy functions. And we're not just doing this just on its own. If you look at the broad macroeconomic conditions, which you would say are ideal, we have had a very big debt situation. The government has made tremendous progress in addressing this issue. I think this has been clearly articulated by the Ministry of Finance. That's number one. You have had an issue of the fiscal deficit being very, very high, from as high as 14% of GDP. The government has made tremendous efforts in reducing this GDP. Today, that same SLA agreement is saying that the government is going to run a primary surplus on its budget. And what does a primary surplus mean? I think we were looking at 0.9% of GDP for this year. That means that if you take out interest costs, the government, its revenues are more than its expenditures. And this has important implications for debt dynamics because it means you're not piling on debt going forward. So again, very important fundamental reforms which have been taken place. And there are the other tax reforms on investment and so on, part of which the government has addressed. So the point I'm making here is that when you look at the overall, if you like, the macroeconomic measures you need to take to make sure that you have a permissive base for confidence in the economy, the government is taking those. And it continues to take them and continues to build upon them. So in some sense, we don't have to wait for 30 years to then take measures to deal with the issue of dollarization. We have to deal with it now. And that's basically the point we're making. Now, in terms of market incentives, as I said, the nuances can be given by the fund, but the way we have adopted how we dealt with this issue is simply to say, first of all, let's engage the public and consult. We give our ideas of why we want to move in that way, which we think are sensible, and if we all travel elsewhere, that's the way we function. But we said, let's consult. And we have consulted, and we've learned some very interesting things, some peculiarities in some sectors. But overall, I think there's nothing which takes away from us the idea that we do need to make sure that we can promote the use of the kwacha. Probably that we need to do it in a careful, staggered way, that we need to work on issues, for example, such as the way in which the commercial banks are able to offer instruments in which businesses can hedge. These are all interesting things we've heard and issues which we can work on. But there's nothing which is suggested that we shouldn't move in the area of trying to make sure that we promote the kwacha. And I think that is what we are looking to do. Thank you.
Kelvin, you are raising the issue of the statutory reserve ratio. I don't know if I got you right. First, I think what I got right is that it's a sharper instrument. You're absolutely right. Is compared to, for example, the policy rate. Now, each tool one uses, let me just take at an individual level. If you want to, you have a pool of water you want to deal with, you can also use several things. You can do a trench. If you have space, let the water drain naturally. Or you can get something to help you, which will do it in a short period. Let's say you get a pump, the water pump, you can flush that water immediately. Actually, it happens like in these compounds when we see this flooding. People try use buckets to remove water. Okay, if there is no more water added, you manage at some time, but it will be over a long period of time. But if you get the watering equipment, you get these water pumps, you can do that much quickly. So this is the analogy I would like to extend when you are looking at the policy rate. It takes time to work its way through. Meanwhile, you have the pressure building up. That's why the statutory reserve ratio comes in handy, because it's instant, it gives you the results that you want. So when we are looking at these things, we are looking, what is the pressure? What is the reason we want to intervene? Why do we want to get what, and how long should we wait for that to happen? That's how we choose instruments. So when you use the policy rate, it has a more gradual impact, but we want results fairly quickly, then we turn to the statutory reserve ratio. The other thing to remember is that we meet every quarter. So that we raise the policy, the statutory reserve, even the policy rate last meeting, we didn't raise it last time, for example, but we have raised it now, which means that in a fairly quick turnaround, you can review your position if circumstances change. without really feeling the pinch. Whereas when you come to fiscal side, things take much longer. I've given this example before that I'm sure you have gone for, those of you who go on tourism, Livingstone, I think it's very popular. I think you see, when you go for a boat ride, you find that alongside the big boat, there are small boats which are tied to there just in case you have an accident. What happens? You jump on that so that you can quickly maneuver. So this is how we rank tools also, which we choose when to use, where to use, how long. So the statutory reserve ratio is an instrument, but it has several roles also. We can use it for prudential purposes. If we want banks not to do certain things, we raise the cost of doing that, it discourages. If we want them to do that and they're high, we reduce that so that they are encouraged. So here, when you are saying that, why are you using it? It's because the problem at hand is now. If there's so much pressure on the exchange rate, we can't wait for the policy rate to work its way through. Because by the time it works its way through, things would have changed, deterioration would have extended. So we use the statutory reserve ratio as one of the quick tools to manage liquidity. Let me also just explain. There are two aspects when you are doing with the demand management here. There is aggregate demand. You have said that aggregate demand represented in simple terms by GDP, which is the aggregate demand. That is more amenable to being addressed through the policy rate. But if there is liquidity pressure, like we are seeing, that people are, like we are now seeing, people are withdrawing a lot of money, which they are likely to use to buy foreign exchange. So we move quickly by raising the statutory reserve ratio, because for every deposit that the bank gets, it has to set aside some of that money. So that acts as a disincentive for people to pile up that money. So the choice is determined by the problem at hand and how quickly you want that to be resolved. So many of these tools, like we are saying in the paper, the report, is that we use them in a combination, because there is not one tool which is a magic bullet that can solve all the problems. Each of the tools has its strength and its weaknesses. But when we combine them together, we get a better outcome. So this is what we are saying in this particular presentation, that no, this movement that we have effected will have to be accompanied by other measures. Some are already undergoing, some we are working on. Together, that's what will give us the intended result. Did you, as I mentioned also, the issue of the fiscal? I'm sure in the past you used to hear the fiscal, but now we are seeing that the fiscal is coming to the game by managing the fiscal deficit better, and that will pay off as we go forward. This is what we are saying, that when you look ahead, we see a lot of good things awaiting, but they won't obviously just drop. They have to be worked for, but it will be a lot easier that time to work for those. So that's what we're saying. I don't know if I have answered your question, but that's what I thought I heard you say. Why are you using this? Because it's sharper, it is this. But I'm trying to explain that no, the choice of the two is the problem at hand. You use, if you are a carpenter, you choose what chisel you want to use, a big one or small one, or a sharper, not so sharp. All those are choices that you have to make.
Thank you, Governor. We come back to the House.
Thank you so much. My name is Prudence from Diamond TV. This question goes to, I don't know if it's a question or a clarity to Dr. Chipimo. on the response that you just responded to an online viewer. Let me take you to the statement that was issued by Secretary to Cabinet, Secretary to the Treasury yesterday, Mr. Felix Ekolokosa, on the discussion and mutual agreement, which were hanged on 4 pillars. The third pillar, I think, is where the person who was asking got that particular question. It says, as government, we align with the observation of the IMF that efforts to promote the use of the domestic currency in domestic transactions should be accompanied by market-driven incentives once microeconomic stability is consolidated. So this was actually government that was saying this and not the IMF. That's why that online viewer asked to say which incentives are these which you agreed that you should give to the private sector. I think I kept going through this statement as well yesterday just to understand what you are trying to agree here with the IMF. That's just a clarity for the online viewer. So I don't know what response you'd give to that because this is what the online viewer was trying to find out. Then back to my question now. Governor, we did see companies like First Quantum Minerals announce that in the third quarter this year, they had increased their copper production by 13%. We also saw companies like Mopani produce their first 200 metric tons of copper, in addition to what has been produced on the market. But yet the export of copper decreased by about 6.4%. So I'm just kind of wondering, we are seeing copper production increasing. We also saw on the London Metal Exchange, there was an indication that copper prices rose by 3.2%, but yet we did not export enough as a country. Where could be the problem? First Quantum increased production, Mopani is on board, plus other mines. The price on the metal exchange is favorable, but when it comes to export, we exported less and we earned less money from that. So where could be the problem here? Thank you.
Thank you, Prudence. Next.
Good morning. My name is Tetiwe Mwemba from Live Radio. Governor, I heard you talk of the measures that have been put in place to actually improve liquidity in the country, and you talked of the measures that the Bank of Zambia is currently undertaking. My interest is I want to know the measures that the bank is currently undertaking to improve liquidity, especially at a time like this one where we have a lot of worn out banknotes. 2 kwachas, 5 kwachas, 10 kwachas, and now 20 kwachas, which some of us cannot actually use because they cannot be accepted by those trading on the market. So I want to know what measures the Bank of Zambia is taking in regards to that as well, and what directive you are actually giving. Thank you.
My name is Jessie Waller from Beats FM. My question is, I'd like to find out, as we are concluding the year, at what rate the gold reserves are. Lastly, I checked in July, they were about $190 million. So I'd like to find out, as the year is concluding, have you procured more gold for the reserves? Thank you.
My name is Wamba from the Zambian Business Times newspaper. And my question is, I would like to find out, looking at it, that the interest rates for microfinance institution has reached up to 269%. I just wanted to find out what you as central bank are doing to sort of like lower down the interest rates, and as well as the impact it's having on smaller businesses.
Good afternoon. My name is Chama Sungu. I'm coming from Zambia Reports. We are at a state where every Zambian has hit hardly with the cost of living. I would like to find out how does or what plans are there for the monetary policy, looking at the fact that ensuring that the rate hike does not worsen even the household who are facing challenges like high cost of living, as well as maybe fuel prices.
My name is Munyumba Mutwale from Business Telegraph. My other question is, given the inflation outlook that was given, that we have rising inflation outlook, and the fact that we've given quite a relatively muscular rate hike of 0.5%, we've actually been seeing on the previous bond auctions and treasury bill auctions that interest rates have actually been coming down. So if it seems that the outlooks are that inflation is coming up, one would expect that rates would be on an upward trajectory. but it seems they're coming down. Is that more of the effect of the offshore? Because you did point out that non-residents are now back at 29%. They were lower than that, I think, in earlier times. They're now back at 29%. And is it because of their declining rate environment, or are there other factors that are playing in the declining rates during our auctions?
Thank you. I think in the interest of time, let's allow for Governor to respond. If we don't manage to get all the questions, we can make an arrangement. In the interest of time, let's just allow the Governor to respond. If there will still be room, we can take one or two before we close. Governor.
Thank you very much, Governor. I think maybe let me start with Prudence's question. Indeed, Prudence, if you were listening to me carefully, I'd said two things here. Firstly, that you had made reference to the IMF SLA was where the question came from. And I was basically making the point that the IMF are more than capable of answering what they meant by that. But I then said my understanding of the gist of market incentives. I referred you back to a very good paper which the fund had published when this dollarization issue broke. And they were looking at dollarization not just for Zambia, but broadly, and talking about what are the basic macro things you need to get in place. And the moral of that story, I think, was basically to say that if you have got a lot of macroeconomic discontinuities, you've got very high deficits, you've got subsidies, you've got all these things going on, you can't expect people to have confidence in the economy, and they start to run to the dollar or other forms of money to preserve their wealth. And that was if you want to look at the concept of what are these market forces, market incentives which need to be in place, my sense is they are captured in that basic story. I then said, look, but if you look at what Zambia is doing, we are addressing a lot of these things. We're not disagreeing that you need to have macroeconomic stability. You need to make sure you get your fiscal in place. You need to make sure if you have subsidies, they're going to the right place. Like now, you have subsidies, which are going to cash for work, the increased school feeding programs and so on. But they're going to the right place. So they're saying that you must make sure that you manage your basic macroeconomic policies correctly. And the point I was making was that these things are things which we are doing. The very fact of the SLA itself is a confirmation, because they're saying, yes, we have reached agreement because the government had committed itself to doing certain things, and they have done them. Yes, in any program, there are going to be some areas where you said you can do more. There are going to be some areas where you say, yes, actually you've overperformed, like on the fiscal. And then you're looking forward and saying, okay, so next year, what are we going to do? So that's the critical point I'm saying, that yes, we have looked at those market incentives you have to have in place, if you like, as captured by the broad issue of how do you reduce this dollarization and people running away from the use of their own currency. And the point I'm making is that the government is doing that. And so what we're doing is really just adding to those broader efforts which are being made by the government. That's the basic point I wanted to make. Maybe I can just answer two other points. I think on gold, the governor mentioned where the gold is, and I think we always do because of that. So I'll just encourage you, please listen to the presentation. I think the actual purchase is 228 million, 29 million, if I'm not, 212. Sorry, there's an actual and a market price. The market price is, I think, around $229 million, because what we give is what we had purchased in terms of the kwacha and the value of it. But there's actually a market price, because gold prices is rising, and in our books we have a market price for it, which is around 229 million, I think. So that is happening. Then the only other one perhaps I should talk to is copper. On the copper story, I think it's important to differentiate between the production or the numbers we give on a quarterly basis and the numbers which we think on annually, because I think there's a discussion around copper prices or exports being lower. What I think we have in terms of copper exports for 2024, we are now looking to have something like 7.9 billion as earnings, as opposed to 6.6 billion. This is for the year 2024 compared to 2023. So for the year as a whole, we're looking at improved earnings of copper. And this is consistent with what we're talking about, price and all the other things which are happening. But on a quarterly basis, of course, these change. And with copper, there's also some seasonality in the production which takes place. So I think it's just important to contextualize quarterly numbers which we may give against the overall annual number which we are talking about.
If I may just add one little for your future reference. You talk of production and export. They are not always the same because there's a lag when you produce and when you export. Sometimes there's hoarding of stock before you can export. Then there's also the thing about how some of these commodities are traded. There's forward market and the spot market. So all those give rise to some differences that production and export may not always match. So you have to look at that as well. On the Kitiwe's questions, liquidity measures to improve, I think you sneaked in 2 questions. One, I think what we are talking about liquidity measures here, we are looking at inflation. Right now, inflation is rising. So really, it's not to improve the liquidity, it's to manage that liquidity. So one of the tools that we use is obviously the statutory reserve ratio, which we adjust depending on our assessment of what liquidity has increased. I mentioned also in my presentation that these issues of social cash transfer, cash for work, the adjustments which were made because of the drought, they are well intended, there's no question about that, but they inject liquidity into the system. And that liquidity comes also, if it's not well managed, comes to haunt you by way of inflation going up. Because inflation comes about, if you think in the basic of basic things, if there is a shortage or demand for those goods is higher than the supply for those. So people adjust prices to rationalize the supply of the same. So if you give people more money, but it's not accompanied by more goods made available, the prices are going to rise. That's the basic principle. So in the circumstances we are in, a lot of money was expended, and some of that money came from the SDR allocation that we got as Zambia some time back. It was drawn down. So when you draw that money, some money you take, the SDR is not a traded currency, so you have to convert it into dollar or euro, whichever the case may be. But this money which is given is in kwacha. So now if that kwacha is coming from our operations here to that, that's primary money which is going there. So it is going to add to the pressure that you see. So part of our job is to rationalize these things. It's an ongoing exercise. It's not a one-off. On a daily basis, we have to make an assessment of what is happening. Is there enough liquidity or less liquidity? So that's the way we see it. So right now, we need to restrain some of that liquidity so that it doesn't go to hit the exchange rate, which hits you through inflation. So the concern about higher living, so let me now just combine higher cost of living. This is part of the story. If we don't act to reduce inflation, the cost of living will continue to rise. So, but the process of bringing that adjustment has some pain in it. There's no question about it. But is that the pain you want to endure so that you shorten this suffering that you are enduring? So there is nothing that happens without some friction. So there is a friction. In decision making, There are trade-offs. You are here today. You could have been somewhere else. That's the opportunity cost that you have given up. You can't be in two places at the same time. So you made the choice that this is more important to you. So that's the trade-off. Equally, in managing these economic affairs, you have to see that things are moderated. You don't go excess of one thing because something else is going to suffer. So this is what we are trying to do by raising the policy rate, is to slow down certain things, but we have to do other things elsewhere. This is where now I come to what the facilities we are talking about, which one brought out in the Chibulo. I think he raised that in the budget. There are two facilities which we are promoting. One is the credit guarantee scheme. Those of you who are following this, recently we were at the Bonanza where we had Impact Investing Day, and we went into greater detail of what that entails. There is already 5 billion kwacha which the bank put aside to help deal with the issue of reducing the risk in the perceived and real risk in the SME sector. So if you need more information, I think that information was provided and we can provide it to you at that meeting, because people went into great length to explain how this facility is going to work. And we are targeting the agriculture sector, SMEs, and so and those who are affected by it. Then there's the other one which we are finalizing on what we are calling stability resilience facility. Why do we call it that? Because what we are saying is that with this drought that has hit us, a number of players have been adversely affected. With the electricity generation being reduced, it's a matter of time before you see those who borrowed from the banks and financial institutions being adversely affected. So what do we do to try and help that situation? Remember, we say that we are in making this decision, we are taking into account the impact on financial stability. So we have to have our eyes in financial stability, price stability, and other things. So what we are saying is that this facility will be targeted to try and salvage that situation. But it must be done in such a way that the liquidity that is injected does not come back to hit us with inflation. So that's why it's not just because we announced today, tomorrow you run it, because you have to work through all the mechanisms to see to it that that doesn't come to haunt you. It's like people say, go quantitative easing. It looks nice, but you pay the price down the road, because that money which is given as quantitative easing will come in the way of increased demand. If the production does not follow suit, you are going to have inflation. And this is what we are seeing in the West when there was this quantitative easing. The chickens have come home to roost. That is translating into higher inflation. And to reverse that, they have to raise the policy rates in those particular jurisdictions. So this is what we are trying to do. It's a trade-off game, but balancing the pluses and minuses in such a way that you don't make a situation which is already bad worse off. So calibrating that is not straightforward. Like I said, you are helping someone who needs money, but there is no food they buy. They'll go, the only grocer which is there is the guy adjusts the price. In other countries, actually, it's a pity in Zambia we don't have that arrangement, that there's what is called price gouging. You see, if the prices were at a certain level and there's a calamity which has befallen a country, you are not supposed to hike prices anyhow, because that's price gouging. You are taking advantage of the situation to the disadvantage of others. But we don't have that law. I could be mistaken, but we have been raising this. We don't have it. So you see traders who take advantage. They raise the prices, and you find that that money is not able to go far. So that's why we are concerned that inflation must be brought down, and in so doing, we are preserving the purchasing power of the currency. Okay. Now, the issue about lower interest rates, we all would like to have lower interest rates, but there are challenges. This is why we are talking about this. I think one indicator which someone already said, what happened, why government securities interests came down. I think it was the demand which went up very significantly. Because what happens is that we announce the quantum that we are providing, and then the players bid for that. So if there is a lot of resources available that is for that purpose, obviously they are going to compete that down. That's what happens here when we had over 400% oversubscription in government securities. But there's a bigger issue which is happening here, which perhaps others are not seeing, which you are seeing. As the macro situation stabilizes, we foresee these rates coming down. But in the meantime, they are also pushing other market rates. We have explained this. Why would someone who is in the business of lending lend to someone who could default, or lend to someone where you don't even have to do anything, you get your money? Who is that someone? It's the government. The government securities, you put your money, you can go to holiday, and at the maturity date, you get the money. But if you lend to me, you have to have a monitoring system to see that I am actually producing. I may have borrowed that money, but then decide to use that money to go on vacation. So when you are calling to want to be paid, I'm not there. So that risk. So what happens is that then they factor that into the price, which is the interest rate. So one of the things we are doing, that's why we are calling for government to have fiscal discipline, to have the fiscal consolidation, reducing the fiscal deficit, is to reduce the government going to the market at the expense of other players. You see that I think the domestic financing is put at 1.9% of GDP, isn't it, for 2025, which is lower. This is to avoid what we call this crowding out of the private sector by the. So there are so many factors which go into informing what interest rates be. Inflation is also another. If inflation is at 15.5%, 7%, you'll be crazy if you are in the financial sector to lend at lower than that, because you are losing, and no shareholder would allow you to put that money. So you have to price above that. Now you look at inflation is that, where is the treasury bill rate? It's probably upwards of 20%. So I'll put your money. So they are going to continue to do that until we close these other loopholes. So that's the challenge we all have. When we are talking of macro stability, that's what we are talking about. All the four sectors of the economy, the external, the real sector, fiscal, and financial, have all to work together to bring about a lasting change. If there are imbalances in one, they pop up in the other. So that's why we have to do these things holistically. What was there? Yes, thank you for raising it was a stolen insight, but very useful on the soiled notes. First of all, we stand for clean notes. That's our policy. Two, we would like to apologize that you have had to face that. Because we have seen some rigidities in the system, but we are working on that. We are expecting to get new notes very soon, but in the meantime, we have been encouraging you and others to go digital, use electronic money, because that one, you don't have to go through that. Yes, there will be pockets of where people may not be able to do that. But we are working on measures to see how we bridge this gap. But we'll be coming back to you on this particular issue at another time, not in a forum like this, just to lay out what we are doing, and hopefully we'll work together to make that happen. But in the meantime, we have this challenge that with what we saw with the social cash transfers, cash for work, FISIP payments, suddenly many people want to be paid cash, even where there was electronic money be paid. So that has overwhelmed the system, because what we had planned is that we are going to have the notes come in, but this drought has other aspects which you don't quite see. That's what I was saying, that the drought that you have, you are focusing on one, but there's another angle where it is hitting you. And this is one of the areas. We have seen currency in circulation rise from 16 billion to 19 billion in a short period of time. And that money, once it goes there, it doesn't come back. Ordinarily, what should happen is that people should deposit that money. Then the banks collect it, sort it, and then because we have some standards that we establish, that to be circulated. It's not coming. We don't know who is keeping it, why people are keeping it. When you get the money, spend it. But it seems that there are people who are holding some of that currency. But for the lower denominations, the 2 kwacha, 5 kwacha, we have coins which can serve as perfect substitutes. And that's why we issued coins, because coins can withstand the different weather conditions, unlike notes, especially in the period now we are going into of rain. Like what DG was talking about, the question in response to the question on money bouquets. That's part of the problem. We are not in a position as a country to continue printing. We are not like the US, which can give you those dollars if you want them, because everybody loves the dollar. But us, it's only you who loves the kwacha. And now you are even shunning it. So what do? It costs us money to get it, to print it, to distribute it, sort it. So that's why we have those restrictions that don't destroy it. And it's in the law. But even with that, people still do. Sometimes I cringe. I give someone a very clean note. The moment they hold it, they just cramp and put it in the pool. Say, hey, can you please handle with care, So you are shortening the life of that note. We thought it would last for 3 years. The last 1 year. And especially when you put staples on it, when water comes, it gets soggy and that is destroyed. So let's try to work together to preserve that.
Thank you very much, Governor, for those responses. In the interest of time, I'll call this meeting to a close. Allow me to just say thank you very much to the production team, Fortress Media, ZNBC and Diamond TV crew for your support, and for all of you for taking time to join us. Until next time, thank you very much. Do have a blessed day. May I request that we be upstanding and allow for the governor and his entourage to leave the auditorium. Thank you.